Good afternoon, ladies and gentlemen. It's 12 p.m. and let's start our webinar. Today, I'm the speaker for today's session. I'm Jason Wong, Research Manager for FSMOne. Some of you may have already heard me before in my previous webinars. And basically, I lead the Malaysian research team in Malaysia. And if you see some of the articles, especially those Malaysia-related articles that are posted on FSM's website, some of those were prepared by my team. Without further ado, let's start the webinar. In today's topic, I'll be talking about why we are upgrading Chinese equities and also try to answer the big question a lot of you may have in your mind. Is China's market going to rebound soon? Let's start. In today's agenda, I'll firstly be briefly talking about how markets have performed so far this year, with particular emphasis on the Chinese equity market, before I move on to some of the key catalysts for the turnaround in Chinese equities, and then some catalysts for the Chinese tech sector, which a lot of you may be interested in, especially Chinese technology stocks, Chinese technology companies. Finally, I'll end the session with a Q&A where I'll try to answer most of all the questions as much as possible that you post. So if you have any questions, you can feel free to just type it in the chat box and I'll pick them up later. Firstly, a quick recap of how markets have done this year. This table here you can see are the market performances for those major markets that we cover. And this is until the end of May, okay, 31st of May. As you can see, Chinese equity market is one of the worst performing compared to a lot of other developed markets and also even ASEAN markets. China faced a lot of headwinds along the way. As you may be aware, there are a few headwinds that came about, such as the Russia-Ukraine war. There were fears that China was supporting Russia in terms of the war, but immediately the Chinese government, led by the foreign minister, came out to debunk this, to tell investors around the world that they have no part in this war. In addition, China stocks were also affected by the ADR delisting fears, because in the US, the US authorities wanted to audit the Chinese listed companies in the US, but the Chinese government didn't allow initially. Subsequently, there were fears that all these ADRs were going to be delisted, and this caused some sell down in especially those Chinese tech stocks over there. In addition, there were also lockdowns that happened in China, especially those major cities, and this caused people or investors, the markets, to be more concerned about the economic slowdown over there. So these are some of the factors that drove the markets to drop in China. Subsequently, what we've seen since the middle of March, as you can see here, there was a big drawdown in Chinese equities in the middle of March, but subsequently, we have seen relative stabilization in Chinese equities. And this was relative compared to what we've seen in other major markets like US, S&P 500 index, NASDAQ, Europe as well, and the rest of the world in Asia. There were big drawdowns, whereas Chinese equities turned to be more stable subsequently. So this was amidst some of these fears of rising inflation. As you have probably read in the news, in the US, Europe, all these major economies were facing spikes in inflation, multi-decade highs inflation. This caused a lot of central banks, such as the US Fed, Bank of England, and potentially the European Central Bank, to start aggressively hiking interest rate. And this caused markets to have more fears in terms of recession because of the aggressive interest rate hikes, which could drag down the global growth. Relatively speaking, Chinese equities have been relatively stable amidst supportive policy measures from the Chinese government. Next, I'll be talking about some of the key catalysts why we think that there's a turnaround in Chinese equities. Number one, we have seen aggressive policy actions by the Chinese central bank in order to stabilize the economy. So as I mentioned, this year the Chinese economy was dragged down by some of the lockdowns that happened, especially in the major cities like Beijing, Shanghai, Shenzhen. So these are the major economic hubs or major economic points in China. So definitely a lockdown in all these major cities would cause some ripple effect towards the overall economy in China and even the rest of the world. So if the Chinese government were to, they still are committed to achieve their GDP growth target of 5.5% growth this year, they will need to do other things, because if there's a slowdown in all these major cities, overall economy in terms of production and also consumption will be affected. So they need to boost the economy through other methods, such as monetary policy. So what we have seen this year is that since January until now, there have been a slew of policy actions by the government to help support the economy amidst this slowdown, especially if they are going to continue this zero COVID policy, and lockdowns could happen again if, let's say, there are more outbreaks. So policy action is even needed in order to sustain the economy. For example, in January, the government, they cut the 1-year LPR. LPR is loan prime rate by 10 basis points, and also cut the 5-year LPR by 5 basis points. So essentially, that's their interest rate over there. And by cutting this, it makes borrowing costs lower, and it should help boost lending, boost the economy in the country, because when people have more, they can borrow more easily, then they can invest, they can buy property and so on. Businesses can borrow to sustain their business and etc. In February, several banks in major cities, they also lowered down the payment ratio for first-time home buyers from 30% to 20%. So this is significant. In the past, home buyers in China, they needed to fork out a big chunk of the down payment in order to buy a property. But by lowering this to 20%, it makes it more affordable, especially for those first-time home buyers to buy property. And this came amidst the slowdown in the property sector in China, which was triggered by some of the defaults that happened in the property sector, like the big ones like Evergrande, Sunac, Shimao, and etc. In March, the government also announced that they're going to issue 3.45 trillion yuan, that's a lot, okay, of special bonds. So these bonds are borrowed, they borrow money to invest in infrastructure, to build more infrastructure. And this issuance was initially expected to be completed by September. At the same time, they also announced tax reliefs to 2.5 trillion yuan in order to boost the economy. Banks also lowered the lower bound range of mortgage interest rates for the first time by 20 basis points, essentially making it cheaper to borrow money to buy property. They also lowered the 5-year LPR by another 15 basis points on top of what they lowered in January, in May. And they also announced a new round of 140 billion yuan of tax relief for the corporate sector and households, including a cut in purchase tax on cars to boost consumption over there as well. They brought forward the special bond issuance from September to June, so the money is expected to come in faster and can be deployed to build more infrastructure faster. So these are some of the policy actions that we have seen this year, and it gives a sign that the government is committed to do whatever it takes to sustain the economy. Okay. In addition to the policy actions that have already been done, so those that I mentioned were already implemented. There were also verbal intervention by especially some of the key heads in the Chinese government to come out to say verbally that they're gonna support the economy. So for example, in March, they came out with a brief statement. They vowed to ensure stability in capital markets, support overseas stock listings, resolve risks around property developers, and complete the crackdown on big tech as soon as possible. So after this statement came out, that's where you saw the big rebound in the first chart over here, the big rebound that we see here, thanks to this verbal intervention that we call it from the Chinese government. Furthermore, in April 29, the Politburo, which is the policy-making committee in the Chinese Communist Party, basically the top leaders in the Chinese Communist Party, said that it will step up policy support for the economy. which includes greater investment in infrastructure this year to boost growth. Okay, so these were some of the verbal things that they promised that they will do. They haven't implemented it yet, but knowing how they do things in China is that most likely this will be in place or will be coming forward in the near future. In addition, policymakers in China also pledged to normalize regulation and support the development of internet consumer companies. This came after the big sell-off in Chinese technology stocks, and there were a slew of new regulations that were implemented across in the past 1 year or so, and this caused a big sell-off. But they are trying to reverse this through this pledge. Okay, trying to normalize regulation and support the development for longer term. In May, the Chinese Premier Li Keqiang also warned of dire consequences if officials do not move decisively to prevent the economy from sliding further, and said that a contraction in the second quarter must be avoided. So that even the Chinese Premier also came out to give his thoughts or his warnings, especially basically it's like a top-down direction from the top that you must do whatever it takes to prevent the economy from sliding further. So in terms of the aggressive policy actions, we are seeing it a lot this year, coming in a lot this year, and this has boosted the equity market in China. The second key catalyst for a rebound in Chinese equities will be the emergence from COVID lockdowns. If you have been following some of my webinars previously, I also mentioned that this will be, it shouldn't be a big concern in China, all these COVID lockdowns, COVID outbreaks, because they have managed to do it quite well in the past. And in fact, if you look like in 2020, they were one of the first countries to manage the COVID pandemic better than the rest of the world, and they reopened the economy faster than the rest of the world. So going forward, we expect China to improve in terms of the COVID situation, and we are also seeing it in the data. So we have this chart here, the daily COVID-19 infections in China, and it has dropped sharply from the spike that we saw in March and April. That means they have managed it well, and they brought it down back to close to zero numbers, essentially close to zero, because Chinese population is so huge. In terms of the activities in China, it is also slowly going back to normal. In terms of Shanghai's sea and airport cargo volumes, they are back to 90% capacity. Public transport has also resumed. There's a pickup in terms of the usage of public transport, because workers, they are finally allowed to go back to office. I have a chart here, which is the Shanghai metro passenger volume. So this is the normal type of volume. And due to the lockdowns, there was a big drop, close to zero, that there's no passenger at all, essentially. But recently, because of the gradual reopening, the partial reopening, you start to see some people taking public transport again. So in terms of the COVID situation in China, we can say that it's pretty much under control already, and they're starting to reopen. That should be a booster for the economy and also the equity market in terms of investor sentiment. We think that the zero COVID policy is unlikely to go away for China. They will continue to their conviction in terms of keeping the COVID situation close to zero. Therefore, that means, in other words, they need to stimulate the economy in some ways or another. Okay, such as the policy actions that I mentioned just now. The Chinese Premier Li Keqiang, in addition to this, recently he also summoned a meeting with 100,000 officials through a video conference to push for a faster easing of lockdowns. This is actually the first time that such a big meeting has been held in China, and to so many layers down. So normally when the Chinese top down, the government, they give a direction, they give it to the second layer or the third layer. But this time round, through this video conference, it actually goes all the way down. So that means that it shows that they are very committed to a faster reopening of the lockdowns and a improvement of the economy. Next key driver will be earnings. So far, earnings outlook have been very pessimistic. If you look at this chart here, it's the year-to-date earning estimates for MSCI China for 2022. That means at the start of the year, analysts, they were expecting Chinese equities to earn about 6.3 cents per share. Subsequently, because of the Russia-Ukraine war and also the lockdowns, this caused a sharp deterioration in terms of the earnings expectation for this year. Ultimately, when the economy, especially those major cities, when they get the lockdown, the economy will slow down, it will affect businesses and their revenue and their earnings. So this happened, this sharp drawdown. But subsequently, starting from May, we have seen a stabilization. And this is in line with the gradual reopening of the major cities in China. So this also contributed to the recent stabilization of the share market as well, because of a lot of the negativity have been priced in. So there's a stabilization of the earnings, so giving better investor sentiment in addition to whatever I mentioned just now in terms of policy action. In terms of this year, it has been downgraded by 12%, roughly 12% since the start of the year for Chinese equity earnings. We think that this is overly pessimistic. Okay, a lot of negativity have already been priced into the market. So in other words, if things start to turn better, okay, the economy rebounded faster than expected, or things turn better than expected, we should see some earnings upgrades, and this will be a potential catalyst for the equity market as well. So if we start to see now we are seeing a stabilization. If we start to see a reversal of this, start to see some pickup, more positivity, then it should be a booster for the equity market in China as well. In terms of fundamentals, when we talk about China, let's look at the P and the E's, the price and also the earnings expectation. Starting from the earnings expectation, going forward, currently in terms of earnings in 2021, they are expected to earn about 5.67 in 2021 and 5.96 in 2022. So despite the downgrade that I showed you just now, they're still expected to post positive earnings, okay, and also some earnings growth compared to last year, a 5.1% earnings growth compared to last year. And going forward, expected to see double-digit rebound in earnings. So from 5.96 to 6.97 and a 7.85 in the following 2 years. So based on that, you can have a double-digit earnings growth for Chinese equities for the next 2 years. And in terms of PE, for the price that you pay today for Chinese equities and earnings that you're expected to get in the next 2 years, up to 2024, the PE is around 10.3 times, which is relatively cheap, especially when compared to historical and also compared to the fair PE ratio that we have on the market of 14.5 times. So it's a few multiples below the fair PE. And we estimate a 40% upside from this level for the Chinese equity market. And therefore, the three catalysts that I mentioned just now, aggressive policy action by the government, then the second one is the reopening of major Chinese cities. And the third one, a stabilization of earnings and potentially upgrades of earnings. These three catalysts. And also, because of the sell down in Chinese equity market this year, we have the upside potential has increased. Okay, and because of that, we are upgrading China to 4.5 stars, very attractive, from 4 stars before. In short, if there's a good time to invest in China, it is now, we think. And next, I'll be talking about a bit about the Chinese tech sector. So hopefully you get an indication of how the outlook is for the overall Chinese equity market. But now I'd like to zoom into the Chinese tech sector in particular, because it has been underperforming in the past 1 year or so. And we think that it's time for the phoenix to rise from its ashes, according to this chart here, this slide here. Here I have a summary of how much the Chinese tech sector has retraced since the peak. So 2021 and 2022 was tough for Chinese tech stocks. in particular, since the beginning of 2022, the situation has not really shown any sign of improvement. Year to date, they're still down. Year to date, still down. And they continue to hit new lows due to the impact of the Russia-Ukraine war and also the lockdowns that happened in China and also the ADR delisting fears. So they continue to drop. But recently, we have seen a rebound and stabilization. Similar to what I showed you just now in terms of the overall Chinese equity market. Some of the events that happened throughout the 1 year or so include like some FOMC meeting where the Fed started to mention that they start to taper, and basically the Fed, they think that the employment and inflation targets have already more or less reached, and they can start to taper already. This caused further sell down in Chinese tech companies. In addition, Hong Kong also raised the stamp duty for trading of stocks in the Hong Kong Stock Exchange. This caused a dip after the news came out. There were also a slew of regulations that came out from the Chinese government, especially targeting Chinese tech giants. I'll talk a bit more about this later, but this also caused further sell down in the Chinese tech sector, Russia-Ukraine war, and subsequently, more recently, it will be the introduction of various policies that I mentioned, which also helped to stabilize the tech sector over here. Since last year, 2021, there have been a slew of new regulations coming out to regulate the internet and education and gaming industries in China, and this caused further sell-off in the sector. Several policies, I'm not gonna go through each of them one by one, but maybe I'll pick some of the examples which I think are worth talking about. So a lot of these regulations are not necessarily bad regulations. Okay, I'll come up with some examples. And this is basically what the Western economies have been doing for some time already. They have been introducing anti-monopolistic regulation. The Western markets have also fined all those tech companies before, like Microsoft, Facebook, Google. They have all been fined before. It's only recently that the Chinese government felt the need to come out to start regulating all these big tech companies and make it a more competitive or fairer playing ground for every tech company in China. So some of the measures that were introduced were not necessarily bad. For example, if you recall, previously there was this Chinese coffee company called Luckin Coffee. So they were listed in the US. Subsequently, they turned out to be fraud because they actually manipulated their sales data in order to look very nice in terms of financials, but it turned out to be fraud. They manipulated because they can just create sales out of nothing just by clicking some buttons. So you artificially create sales. So this kind of fraud actually triggered the government to implement a new rule, which is they're gonna. It's part of some of the rules here, like provisions on prohibited acts of unfair online competition, for example. So what they did was that they were gonna hire third-party independent auditors to go and audit some of the numbers that were being published by all these tech companies. So after the Luckin Coffee incident, they're trying to clamp down on all these fake transactions. So they're gonna hire third-party people to come and monitor the numbers to make sure they're correct numbers, they're real data. So this actually is a good regulation, I think, because you can in the past, maybe if you were to look at some of the numbers that were posted by tech companies, maybe you would look at numbers and take it with a pinch of salt. But if you know that at the back, the Chinese government are regulating this, they are monitoring this, and then it will reduce some of the fraud and give more confidence to foreign investors, especially in the numbers that are posted. Okay. Other than that, there are some regulations that were implemented to curb some of the monopolistic behavior by some of the big tech companies. So, for example, in China, there were a lot of taxi hailing app or ride hailing apps, but it occurred that some of the bigger tech companies, the bigger taxi hailing companies, actually created fake rides, okay, on their competitors' apps. So when the drivers go until the place to pick up the person, there was no person over there because it was created. There were fake transactions. So this kind of monopolistic kind of behavior, because ultimately the bigger companies are well capitalized, they have more funding, so they can do this kind of, they have the funding to do, or the capital to do this kind of thing. So it affected the smaller tech companies or the smaller ride hailing companies. So by having this regulation which prohibits all this all this monopolistic or unfair kind of behavior, it creates a more fairer playground for all the tech companies over there. So these are some of the examples that, yeah, to show you that not all the regulations here are bad. In fact, they are not trying to stifle growth. They're trying to create something more fairer, more competitive playground, so that there's more sustainable growth in the future. Another example probably I can think of is that in the past, let's say you're a business, if you wanted to list your shop in an e-commerce platform, if you were to go to Alibaba Taobao, then Alibaba Taobao will have a sort of like a agreement. If you wanted to sell on our platform, you can't sell on other places. So because of this new regulation, it actually opens up all these businesses. They can now publish, or they can now sell their goods on other e-commerce platforms instead of just one in the past. So it's actually better for competition. So I've talked about the regulations a lot. Now I move on. These regulations ultimately did cause a big sell down in Chinese tech companies, and a lot of the tech companies were sold down much more than the index. So the drop was much more than what we see in the index. Some of the companies are very well-known companies like Bilibili. This is the YouTube of China. Alibaba, I think everyone probably know this. Xiaomi. So all these companies saw big sell-offs from their peaks to trough, very big sell-off. But they're actually very good companies. And if you use their products, you know that they're good. Okay, you definitely you find some value added from these companies, from what they do. And in fact, a lot of the innovation that they are doing are being copied by overseas, the Western tech companies, in fact, nowadays. So this has caused a big sell down in all these tech companies. But if you like the thing that they do, if you think that going forward, they continue to add value to consumers, to users, to businesses, and they're trading at much cheaper valuations right now, definitely there's opportunity over there to pick up some of these. Now I move on to the key catalyst for this China tech sector. So just now I mentioned that there were policy actions by the Chinese government to boost the economy. There are also actions, policy actions from the Chinese government, particularly to the Chinese tech sector as well. So recently we have seen in the past 1 year plus, there have been a slew of regulations to regulate this tech sector, right? But recently we have seen a sort of like a change of tone. There seems to be a more neutral kind of view, and in fact some more positive kind of policy measures that were implemented. So for example, recently the China government, they have come out to signal its commitment to support overseas listing. So one of the fears that caused the drawdown in Chinese tech or Chinese stocks overseas was the ADR delisting fear. So the US regulator wanted to clamp down on, for example, like cases like Luckin Coffee like that, which was listed in US and turned out to be fraud. So the US regulators wanted to clamp down on these. Then they wanted to bring in the PCAOB, which is the Public Company Audit Overseas Board. So this is a non-profit organization to basically do some on-site audit inspections on some of the numbers that are posted by these Chinese companies listed in US. Okay, but initially the Chinese authorities didn't want to allow that to happen. So they didn't want the data, more specifically the data of China-related consumers to go into foreign hands. So this was one of the concerns. They didn't allow that. But recently there's a sort of like a change of tone. In 16 March, multiple departments, including the Ministry of Finance and China Securities Regulatory Commission, they issued joint statements that they will maintain a healthy and stable development of financial market and prevent occurrence of systemic financial risk. Among them, if we pick out the keywords, statements include actively introducing policies favorable to the market, encouraging and welcoming long-term investment, encouraging corporate to repurchase, and supporting the healthy and stable development of Hong Kong's financial market were mentioned many times. Okay, so in true statements from a lot of these Chinese government-related ministries or commissions, they come up to give their commitment in terms of supporting the equity or the capital markets. In the 1st of April this year, the Chinese authorities also announced draft rules on revising the rules that some of the rules that were implemented in the past 1 year plus. And this also included the change which allows the PCAOB that I mentioned just now to conduct all these inspections. So previously they didn't allow them to do the inspection because of data fears, but now they are more lenient on this already. And this was one of the triggers why you can say the tech sector actually started to rebound subsequently. This is a good sign that they are actually more shifting towards more cooperation with all these regulatory authorities, especially like the US, to conduct cross-border regulatory activities safely and efficiently. So in our view, the risk of delisting because of this change in tone, these statements have significantly declined. It's still there, the risk is still there, but the risk has significantly declined, and it opens up opportunity for Chinese companies to continue to be listed in US or for new companies to list in US. Okay, but during this one year plus, a lot of the ADRs that were listed in the US, the companies actually did dual listing. They relisted in Hong Kong, especially. There are a lot of notable ones that relisted, like Alibaba. So the companies, they're already doing what's needed to you can say diversify away from this delisting risk, and also you can say open up another avenue for reaching out to capital. So in some ways, we think that this delisting fear has decreased significantly, but it's not really gonna be a big worry, especially if a lot of these Chinese tech companies have already moved towards like Hong Kong listing or Shanghai listing or A-share listing. It also gives us the confidence that the Chinese regulators, they intend to walk their talk in terms of the supporting overseas listing and stabilizing the financial markets, strengthening the cooperation, and also continue to open up the financial market. So these are the recent happenings that happened, and it gives investors some confidence in that sense. Another statement that I mentioned just now is that this one, encouraging corporates to repurchase. So in the past, right, actually in the US, share repurchase is a big thing. Actually, a lot of companies, to create more value to their investors, basically they can either continue to grow their earnings, continue to grow their revenue, grow their earnings to generate the EPS growth, or they can use the cash on hand rather than pay out dividends, okay, to buy back the share. So it will reduce the pool of shares in the market, and then it will boost EPS essentially. So what we have seen recently by Chinese tech companies in particular is that they have a lot of cash flow. Their balance sheets are very strong. So other than giving out dividends, they actually use that to buy back shares. So these are some of the notable names: Tencent, Bilibili, NetEase, Alibaba, JD, and Baidu. So by buying back the shares, you can say that they're actually providing some support to the share prices. So there's a stabilization in terms of the share price drop already. It doesn't like really you'll probably not hit the March 15 lows anymore. Most likely no. And one of the reasons with the buyback program that's ongoing. So these are big numbers. Like Alibaba, they are committed to buy back 10 billion shares, okay, initially, and they increased that to 15 billion US dollars of buying back the shares. So these are some of the examples. I'll probably not go through all, but essentially that's what they have been doing as well, and this gives some support to the market. And the third key driver for the Chinese tech sector is the focus on second curve growth that we have seen recently. In the past 1 year plus, because of the regulation, so a lot of tech giants have had to go through some reforms, and those were quite painful. Like, for example, like the Ant Financial incident. So they need to restructure the company, okay? And yeah, it does affect in terms of the business growth and also the profitability in the short run. But a lot of these tech companies, they are trying to diversify away from the first curve, okay, the main core business, to other businesses away for the second curve of growth. So for example, like Tencent, everyone knows them because of their WeChat app, because of their gaming platform. They are one of the biggest gaming company in Asia, in fact. But now they're trying to leverage on whatever the technologies they have, and also the consumer base, to move more into fintech business, which is another curve for them. Then Alibaba, another example, everyone knows them as an e-commerce platform, but they're putting a lot of emphasis in terms of their cloud business nowadays, because it's also a booming business, especially in a digitalization world that we have right now, where everything is moving towards the cloud. So this is where Alibaba is putting a lot of emphasis. Baidu, so everyone knows Baidu for their search engine, but they are also focusing a lot on their AI business, or their which includes the robo taxi. So Baidu is one of the leaders in China in terms of robo taxi, self-autonomous vehicles. So these are some of the second curve growth drivers for all these tech companies right now, and they do have the balance sheet to do that. All these companies are profitable, and they have the leverage. They have the existing customer base, for example, to cross-sell all these different kind of products. So it's definitely something to watch out for all these tech companies. And if we look at the recent financial statements from all these tech companies, they are reporting that the proportion of revenue generated by these new businesses, for example, those that I mentioned just now, have been increasing. So this is a new growth driver for all these companies, and you see a lot of emphasis on this. In terms of valuations, okay, back to fundamentals again. 2021, there was a negative EPS growth. So from 195 earnings per share dropped to 163.99. But in 2022, we expect a big rebound, okay, 43% rebound. So this drop was mainly because some of the fines that happened. Okay, so in addition to the clamping down on the regulations, let's go back to here. So some of the companies were fined, like Meituan, Tencent, Alibaba. They were fined for monopolistic behaviors. So this caused a big drop in terms of earnings. But ultimately, their core business, their operating business, is still very strong. So 2022, without the fines, you take down the fines, expect a strong rebound. Earnings per share jumped to 235.65, and then jump another 33% in 2023. Okay, 313.89. So fundamentally, they are very strong companies. I also have a breakdown of all the major constituents for this Hang Seng Tech Index, like Xiaomi, Alibaba, all this. Then you can see their market cap, you can see the revenue forecast, and also the earnings growth for the 2021 to 2023. And most of them are expected to post quite strong growth numbers going forward. So fundamentally, they are very strong companies. But the share price has dropped a lot, correct? As you can see in the previous chart, this one, from the peak of 11,000, it dropped all the way to 4,500. So more than half. And a lot of companies, more than half. So because the prices have dropped so much, but in terms of the fundamentals, the earnings, you can see yourself, it's looking still quite solid. That means the PE is even cheaper. Okay, currently they're trading at around 16.9 times PE, forward PE, based on 2023 earnings. And our fair PE for the sector is actually 30 times. Okay, and typically, right, if you have been following a lot of these tech companies, especially like Tencent, because Tencent has been listed one of the longest listed in terms of listing history. If you have been following this stock, they normally trade at 20, 30 times PE one. So because of the sell down, it's trading at the cheapest valuation since IPO, basically. So in terms of the upside potential, currently they're trading at about 16.9 times PE, but we think that the fair PE is 30 times. Okay, that means the upside potential is more than 70% for Chinese tech companies. Of course, in terms of, we think that most of the negativity have already been priced in, but it doesn't take out the fact that it is a volatile sector to be in. Okay, that the investors who invest in this need to have some kind of know the fact that it is a volatile sector. There's volatility when investing in China or China tech sector or China tech companies. Ultimately, China is still regarded as an emerging market, so the volatility, the risk factor is there. But the upside potential, the long-term growth, fundamental growth of the economy and also the sector are there. Just need to bear with the volatility along the way. Now I move on to the recommended fund. So for China equity, our recommended fund is RHB Big Cap China Enterprise. Probably you're aware of this fund. We talked about this fund quite a bit. This is the fund compared to the MSCI China Index since 2013. So here I've put the calendar year returns just to simplify everything. And you can see that historically they have done quite well in terms of absolute return, producing green color returns for investors and also outperforming the benchmark. And this chart here is a calendar year alpha, basically how much the fund outperformed compared to the benchmark. And you can see they have quite a solid track record over the years. Although 2021 was like disappointing, but they still like did slightly better than benchmark. Similarly, year to date as well. So I think this continues to be our recommended fund for next year as well. In terms of the portfolio positioning, they are majority in H shares. So in China, MSCI China has a combination of H shares and A shares. So H shares are Hong Kong listed Chinese companies. So those Chinese companies that are listed in Hong Kong, so they trade in the Hong Kong Stock Exchange and trade in Hong Kong dollar. Then there's also A shares, which are onshore market, the Chinese companies that are listed in Shanghai, Shenzhen, all these places. So those are A shares. Currently, the fund is more allocated to Hong Kong, as you can see here, 71% in Hong Kong H shares, and then they can invest in A shares wherever they see the opportunity. But currently, most of them are Hong Kong. And some of you may ask, like, oh, which is better, H shares or A shares? Actually, both are good because you have different opportunities in different markets. A lot of Chinese companies, they may be listed in A shares but not listed in H shares and vice versa. So for example, Alibaba, Tencent, Meituan, so all these are listed in H, but they are not listed in A shares market. It's not listed onshore. But if you look at some of the companies listed in A shares include like if you're those renewable energy companies, those battery makers for electric vehicles, so the biggest one, that one is listed in A share market, so you can't get in H share. And some of the baijiu makers, the liquor makers in China, if you want to tap into this market, that one will be in A shares, not H shares. So there's opportunities in both sides. And funds like this can actually give you exposure to both. So it depends on the fund manager where they see the best opportunity right now, and they'll allocate accordingly. And currently, in terms of sector allocation, a lot of tech. Okay, ultimately, fundamentally they're strong, as I showed you just now, and valuation-wise, super cheap. Okay. In terms of ETF, so just now I mentioned is an actively managed equity fund. If you want to look for a passive equity fund, then you can consider ETF. Our recommended ETF for China is iShares Core MSCI China. basically they track the MSCI China Index, and you can see the holdings very easily. Is available online, so it's very transparent. And yeah, a lot of the big tech companies are here as well. If you wanted just China tech companies, we have this iShares Hang Seng Tech ETF. So all your big tech companies, if you just want one fund to cover all, then this will be a consideration. This ETF tracks the Hang Seng Tech Index. Okay, so those tech companies listed in Hong Kong. Key takeaways before I move on to the Q&A. So we're upgrading Chinese equities from 4 stars to 4.5 stars to show our conviction, to reiterate our conviction on China. If there's any good time to enter China's stock market is now, we believe very strongly. In terms of year-to-date performance, it's one of the worst performing markets. But since middle of March, China has actually been the bright light amidst the recent market volatility, especially in the US and also US technology companies. So China has actually been relatively stable for the reasons that I mentioned just now. We believe that these are the key catalysts for a turnaround in Chinese equities. Number one, aggressive policy action by the central government to stabilize the economy. And in addition to whatever they already implemented, they also given their verbal commitment that they're going to do that. So that's a positive signal for markets and also investor confidence, especially. Number two, the China economy is emerging from COVID lockdowns. So this will be, the economy overall will stabilize. And if things start to turn better than expected, we should see more positive movements in the Chinese equity market as well. Number three, earnings outlook, they have been overly pessimistic in our view, and they have been downgraded a lot. A lot of negativity have been priced in already. And if we see some stabilization and some reversal of this, I guess there's some more positive pickup in terms of earnings upgrades, then it should be a booster for the equity market as well. So as a conclusion, we're upgrading China to 4.5 stars, very attractive. In terms of China tech, we think that the market has seen a policy bottom. Okay, after all the regulation have been introduced, we have seen a recent change in tone. Okay, from the central government to support the tech sector in particular. Corporate buyback boom is also a booster because, as I mentioned, all these Chinese tech companies, a lot of the big ones especially, they have strong balance sheet. They can actually use that cash to buy back the stock, and this should provide some support for the stocks. Then number three, focusing on the second growth curve, how they're gonna emerge from the slowing core business is to move towards the second growth curve. Some of the examples I mentioned just now. So as a conclusion, we remain positive on the sector. We forecast more than 70% upside potential due to the attractive valuation and also earnings prospect. Okay, there's strong earnings growth expected for the sector going forward. Now I move on to Q&A. I think there's quite a number over here. Let's see. So what about Chinese stocks which are listed in NASDAQ or Dow? Is there a difference between purchasing them in the US versus Hong Kong, China market? Okay, so this is Chinese stocks listed in US are basically they call it ADR, American Depository Receipt. So it's an agreement between the investment banks in the US that by owning one of these ADR, they technically own a part of the Chinese stock or the Chinese company. So because of I think just I mentioned also the US regulators, they wanted to clamp down on some of this fraud. They want to introduce this, they bring in this PCAOB to come and audit some of the numbers on-site inspection. This caused a big sell down over there. So a lot of Chinese companies have actually started to do dual listing, relist in Hong Kong or in China like that, to reduce some of this risk. Okay, if let's say because of that, right, you can actually buy all these companies in Hong Kong. You don't need to buy the ADR anymore. So this would also reduce all the delisting risk for you. Okay, but if you do happen to hold some of them, okay, you have to see what's the arrangement. some of the companies, they actually have arrangement to allow investors to convert into the Hong Kong listed one. So depends on the company, but most of them do. For fund managers, they would have already adjusted. If you look at like Big Cap China, they only hold like 1.65% of their portfolio in ADRs. Okay, they already reduced the ADR amount to, basically to kick out this risk. And they actually, we recently talked to them, and they also think that the ADR delisting fear also quite bottom already, and it seems to be more positive over there because of the new policy measures. So what's the difference between them? Actually, if you buy Alibaba, there's Alibaba ADR and Alibaba Hong Kong one. Actually, it's the same company, but I would suggest you buy the Hong Kong one because you can just, if you have the choice, just eliminate the delisting risk over there. Similarly, like Tencent, you have Tencent in Hong Kong and Tencent ADR. Just buy the Tencent Hong Kong one. Yeah, most of the fund managers are also doing that. I bought, okay, the questions are jumping around. I bought RSB Big Cap China in January 2020. Should I average now? Yes, I think you should. Okay, if you bought in January 2020, then you should be down quite a bit. Okay, so if you have done dollar cost averaging before, you'll find that it's faster for the fund or the stock to rebound, okay, and recover the losses faster. So this is just pure mathematics. So let's say you invested last time at $1. So $1, it dropped until 50 cents, right? So the share price dropped until 50 cents. You lost 50%. But from 50 cents to go back up to $1, it's 100% rebound. So the stock needs to rebound by 100% for you to break even. But if you were to average down, even like a bit, it will actually help to, you don't need to rebound 100% to recover back to break even. Okay, if you even average down a bit, it will help to reduce. So it depends on how much you can average, but definitely I do recommend to average down. And we're not just averaging down for the sake of averaging, we're buying into strong companies at cheaper valuation. And yeah, it's not like the companies don't have weak fundamentals. There are definitely strong companies with strong fundamentals. If I were to look at some weaker companies, for example, like Serba Dynamic, okay, so that company, you know what happened lah. Fundamentally, because of the issues that they have, the share price dropped a lot, right? The share price dropped a lot, but would you want to continue to average down in those? Maybe not, because of the issues that they have. So if let's say Tencent, Alibaba, all this, fundamentally they are strong companies that going forward, there's continue to be a big part of the Chinese economy or even the rest of the world. Yeah, it's a good time to average down. Got a lot of questions actually. I think I try to answer a few more because in the interest of time. For Shara focused investors, would you recommend RSB Shara China focus as well? Yeah, I think similarly it's managed by RSB. RSB China focus. The difference is that it's mainly focused in A-shares market, okay, and Sharia compliant stocks. So if you're looking for Sharia compliant stocks and also in the Asian market, yeah, definitely the Sharia China focus is one to consider. Will China market further going down to bottom? Okay, this is an interesting question. I think if you followed me in the previous webinar, I also got mentioned that I think that the bottom for China market should be the March 15 one. Okay, so subsequently it has not dipped below that, as you can see here. I think this is the bottom. So from the bottom, right, this is about 70. Now it's about 85 already. So 25% rebound, I would say, from the bottom. And why I think this is the bottom is that the few catalysts, other than the few catalysts that I mentioned just now, which stabilized the market, is that what happened these few days was what I call a high volume sell-off. Okay, so a lot of investors that bought into these stocks, Tencent, Alibaba in China, in Hong Kong, when they buy into these stocks, they actually do it through leveraging. They borrow money to buy these stocks essentially. And when the stock price drops a lot, then when they will hit the margin cost, and if they cannot cover the margins, then they'll be forced to sell. So this happened during these few days. So you see big drops in the share price that few days, but they were not because of fundamentally the companies didn't do well. It's because they were being forced sold because of margin call. So you subsequently saw this big V-shaped rebound because people with cash, they know that these people are forced to sell. So people with cash will just go and pick up the companies at those very attractive prices. So companies like Meituan, all those, they have rebound. I think Meituan rebounded 100% from the bottom. Tencent, the bottom maybe 200, below 300. Now it's like maybe close to 400 already. So these are some Alibaba dropped until like 70. Yeah, so now it's like 100 over 130. So the subsequently people with cash saw the opportunity and bought in. So this high volume sell off, I think this will be the bottom lah. So far it hasn't reached the bottom yet. So essentially, let's say you're buying now, then maybe this is the potential worst case scenario, I believe, okay, in terms of the downside risk if you were to enter now. Next. How would interest rate hike in US affect China's GDP growth? Okay, I think interesting question. Currently, markets are pricing in slowing growth, global growth. So overall, the global growth expected to slow down compared to the start of the year when things were more positive. So part of the reason why Russia-Ukraine war, slowdown in China, and also inflation. So this caused central banks to hike rates aggressively, and it will ultimately affect consumer confidence and consumer spending because let's say interest rate go up. Similarly for Malaysia also. If let's say interest rate go up, so your mortgages every month, the installment that you need to pay for your housing loan will grow up. So your spending power will be affected, right? You have less disposable income to spend because you need to pay higher mortgages. So the high interest rate hike does affect growth globally. And yes, China's growth has also been downgraded. Most analysts expect like 4% growth. Because of globalization, it does affect a slowing economy in China. But ultimately, we think that China's economy is strong enough by itself, okay, to withstand this slowing global growth. And with the policy actions that's being committed by the government, we think that they can help compared to the rest of the world. And in terms of interest rate, unlike the rest of the world, China actually cutting interest rate to boost their economy. And they can do it because they don't necessarily need to tag along with what's happening with the other central banks around the world. Inflation in China is relatively benign compared to what we're seeing in US, Europe, all these places. But yeah, ultimately they're trying to boost their economy, cutting rates, one of the measure. Other than that is fiscal policy, the infrastructure spending that I mentioned now, they're borrowing money to build more infrastructure and boost the economy. So through these ways, we think that China's GDP growth will not be that much affected compared to the slowing global growth around the world. Consumerism in China is also going on very strongly. So if let's say cutting rates will boost all this, the disposable income, consumerism would actually help the economy as well. Okay, I think this one, Sharia fund, we talked about this. If it can share with us any Sharia fund that can invest in China market except big cap China, yes, we have RHB Sharia China Focus Fund. So that one you can take a look. If you want something, we also have another Eastspring Dynasty Equity Fund. So that one is not particularly China, but Greater China, but the bulk of it is China. So a big difference is that they can invest in Greater China, which includes Taiwan. Okay, so China with a bit of Taiwan is Spring Dynasty equity. You can take a look on that as well. How about China Direct Opportunity Fund? Okay, so this one seems like there are a lot of fund related questions. This one is by principle, so it invests in smaller cap China A companies. This fund is the track record is very strong. Okay, the track record producing alpha over the years is very strong. I think if you already invested in it, you can continue to hold it. It will definitely benefit from what's happening with the overall equity market. And if let's say the fund manager were to pick the strong companies, I mean the outperforming companies, definitely you'll have a good chance of outperforming the market as what we have seen based on the track record in the past. The I think it's definitely a good fund to hold. It's a small cap one, also it's more supplementary kind of portfolio. If you already have a large cap exposure and you want to get some small cap exposure, then you can consider that fund. Okay. Well, a lot of fund related questions actually. So ultimately, I think if the overall market improves, definitely the funds that invested in will benefit. I don't have a similar alpha chart like this for each fund that I mentioned just now because I didn't really prepare for those specific funds. But definitely those funds that are doing their job in terms of picking the right companies and sectors to go in. Should potential sanctions from the US be a concern for investing in China's stocks? I think this is related to the sanctions because of the Russia-Ukraine war. I think at the moment, if the US is concerned about a slowing economy, sanctioning China would not be the wisest thing because ultimately, US and China, their trade volume is huge. US depend a lot on China, and if they were to sanction China, and similar like a trade war that happened in 2018, 2019, it would affect the US economy. So at this juncture, if they're going to hike interest rates and amidst a slowing growth, it will be unwise to do that. So I think should be lower risk in terms of the sanctions for now. In fact, the Chinese government have already come out to say that they have no part in the Russia-Ukraine war. And they have already said that, so it should be okay for now in terms of those sanctions related to that. This year, election year for China. Any comment on the impact on investment? Yeah, so I think yes, correct. This year is the election year for China, which is why I think some of these policy measures have been introduced as well. So if let's say Xi Jinping were to want to strengthen his foothold in the party, a weakening economy and unhappy population would not be would not be beneficial to him. So that's why we are seeing a recent change in tone, especially all this regulation for tech companies, because in the past 1 year plus, they have been introducing regulation, but now it seems like there's a turnaround, and potentially this is because of the impending election that's going to happen. So if Xi Jinping wants to get re-elected, of course, he wants the economy to look better, definitely not recession, then the stock market hopefully do better also. So it will look good on him and have a strong case for him to re-elect. I think, the policy measures that were introduced is also partly have this election year in mind as well. So back to your question, is this any impact on the investment? Yeah, I think because of the election, the policy measures have been introduced to boost the economy so that, it will look better and hopefully Xi Jinping will get his continuing his term. Is A share less volatile than H share? Okay, this one, good question. I don't have the data with me now, but I think in the past, okay, I don't have the exact numbers, but in the past, A shares had been more volatile. A shares had been more volatile because in the onshore A share market, there are a lot of high retail participation rate. But recently, with the influx, especially if you have been following China, they have introduced all this stock connect, which allows, or the QFI program, to allow foreign investors to buy into A shares through the stock connect, and this allowed foreign institutional investors to invest more in China. So I think that actually helped to stabilize the A share market a bit. Okay, so in the past, A shares was more volatile, but because of the recent changes, more institutional investors like funds, pensions, all this can start to invest in China onshore. So it actually helps to stabilize the market a bit. From my observation, seems like it's less volatile than before already. With the zero COVID policy still in place, what will happen if the authority decided to reverse back to lockdown? Okay, I think back to the, let's see. Yeah, in our opinion is that the Xi Jinping is quite an adamant person. So zero COVID is one of his key policies. It's unlikely to go away. And I don't think he will remove it. It's just how they're going to manage the COVID situation. And it will be a continuation of what we see. If there's an outbreak, then they'll close the area, close the city based on how big the outbreak is, and then do mass testing. So it'll be a sort of like a repeat of the process again. But if they do the lockdowns, they boost back the economy, which is what we are seeing right now. So if more lockdowns are being implemented, that means more aggressive policy action, more like rate cuts, all this will have to happen in order to boost back the economy. Let's see. I think let's take one or two more last questions. For those of us already invested in China-focused cross-industries UT, should we exit and buy tech-related UT? I think if your fund, you just take a look at your fund. If they already have a allocation into Chinese tech, then that there's not necessarily the need to sell and then buy only tech-related UT. Ultimately, other than tech, we still see opportunities in other sectors in China, which probably I don't really have much time to go through, but we do like healthcare in China because of the aging population over there. So China population has been aging. If you can see that recently they have introduced previously they introduced the one child policy. So because of that, less babies are being born, and also because of the urbanization of the economy over there, the rising cost of living, a lot of people are giving birth to less babies, so the newborn rate is dropping, and this caused the aging population to increase. And recently they abolished that one child policy already, right? But the impact won't be so fast. So ultimately, overall China economy, China's population is aging. There's definitely a opportunity for healthcare over there. We also like Chinese semiconductors. So Chinese semiconductor, if you recall, because of the US-China trade war, there are a lot. The US was stopping a lot of technology, especially those semiconductor chips or those going back into China, which affected Huawei. If you recall, Huawei couldn't get the chips from US manufacturers anymore, and Huawei also can't put Play Store, Google, Android inside their phones. So if you buy a new Huawei phone, it's actually using their Huawei own developed OS. So because of that, China realized the need for self-sufficiency for all these technologies. So semiconductor is one of their key industries that they are focusing and investing a lot of resources in. Other than that, would be we also like Chinese financials. They have dropped a lot as well, but we still see some strong loan growth in the Chinese financial sector. Their profit margins are quite decent, and they are well capitalized to cushion against potential slowdown or default risk from property sector. Although they don't have much exposure directly to property developers, but yeah, they are well capitalized to cushion against that. Other than financials, healthcare, yeah. EV sector is also quite renewable sector is also quite a booming industry. So I wouldn't say if you are invested in like all China, like across different industry, don't sell it off just to go into tech. There's still opportunity in other places as well. I think we've overrun quite a bit. There's still a lot of questions. I'm afraid I can't answer all of them. But thanks for your attention. Hopefully you have gained something from this session. If you have any question, maybe you can forward to your CIS, and then from there then see maybe if they can help you over there. Okay, that's all from my session. I pass to Yvonne. She would like to talk a bit more about the promotion that's going on. Thank you.
Thank you so much. Thank you so much, Mr. Jason, for the insightful sharing. Now, ladies and gentlemen, this will be the end of the question and answer session. Jason, if you allow to share the screen for the last promotion. So if you have any further questions, you may feel free to send us an email at investhelp.my@fundsupermart.com. The email is in the chat box. A replay of today's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. So before ending our webinar, I would like to draw your attention that FSMOne is having an ongoing promotion in line with the upgrade of Chinese equities rating. So catch the selected China equity funds at a 0.8% sales charge. The participant fund which have eSpring Investment Dynasty Equity Fund, RHB Big Cap China Enterprise Fund, Principal Greater China Equity Fund, MYR Class, MYR H Class, RMB H Class, AUD H Class, SGD H Class, USD Class, and this promotion is valid from 20th of June 2022 until 1st of July 2022. So for more information, you may refer to our FSMOne website as attached in the chat box. Once again, thank you very much to Mr. Jason, and thank you everyone for attending today's session. Have a pleasant day ahead.